I mean, let's just start with Apple, I guess, right, or just mega cap tech. Where do you think investor sentiment is at this point, given the 7 record closes Apple, for example, has had since the beginning of June? And to what degree do you think investors are trying to hedge some of those bets with, you name it, gold or treasuries or some of the other things that have been on the move this week?
Yeah, certainly the move in Apple has been fairly impressive this week, to your point. My sense, it kind of reflects 2 things. One is you're seeing the services business accelerate rather dramatically over the last few months. We've seen the App Store revenue growth, if you may, be 2x the run rate you've seen in the rest of the year, if you may. So services is doing really well. You're at the cusp of this major product cycle with iPhone 5G. So what we see from investors a lot is a little bit or I should say a lot of fear of missing out at this point. So you're kind of seeing folks pile onto the name, largely as you get ahead of this product cycle, given the momentum you've seen on the names. I think that's really what's driving this narrative. Certainly the balance sheet and free cash flow give you some better downside protection versus the rest of the market.
Yeah. Paul, I mean, next few weeks are going to bring potentially a couple of bits of news. One is the testimony of those big cap CEOs in front of House Judiciary. That's going to get interesting, I think, on the 27th. And then if we keep hearing commentary vis-a-vis China from the likes of Secretary of State Pompeo, like we just got this morning, how's the market going to look through all that?
Yeah, I think I'd say maybe 2 dynamics here. There's a whole bunch of stuff around the political economy aspect of things that's very messy and very choppy, and quite frankly has been for quite some time. But I think there's a more fundamental thing that's happening that is purely related to stocks, and I would narrow it down to 2 words. It's digital and virtual. You can just simply run a dividing line, and COVID has really helped create that dividing line, or take the line that was there and make it much, much deeper and broader, and take companies that are primarily in the world of physical businesses with not much digital, not much virtual presence, and the world of people who have really pushed their businesses toward the digital and the virtual. And you can just simply look at that dividing line, and the NASDAQ has really helped define that, and look at all those companies that are kind of running away to the upside, because people are already looking beyond where we are now and realizing that those are the businesses that have the high growth potential going forward, and that's where the money's going.
I mean, I want to go back to Apple, because there's something interesting that I know that you've looked into regarding the stock, and that is Apple offering less for iPhone trade-ins than they were. And I wonder, does this reflect perhaps an increased supply of trade-ins or inventory of trade-ins? Maybe Apple has a lot of unused inventory since its stores have been closed, so they don't want to pay as much? Or does it perhaps reflect reduced demand for older phones? Maybe they can't move them in emerging markets at the rate that they're used to, so they don't want to pay as much for the trade-ins.
Yeah, it's a great question. We spent some time looking at this recently too, and our gut is, especially with the advent of the launches of iPhone SE 2, which has been a fairly successful phone for them, our sense is demand is perhaps somewhat lower in emerging markets for refurbished used phones, and that is perhaps why there's some degree of saturation, which is why Apple can be a bit more selective and not give you as aggressive of a rebate as you've typically gotten. So I think it's a confluence of iPhone SE doing really well, especially in emerging markets, plus perhaps some degree of saturation that's happening out there.